So, wait a minute, this is not another 5-minute SMC or ICT strategy. If you don't know me, I'm Raffaello. I currently manage over 6 million euros for an actual hedge fund, and what I'm about to show you is one of the exact strategies I use to pass my first prop firm challenges and to scale my capital up fast. It is based on convergence models originally used by banks and quantitative funds since the late 90s, so no retail nonsense. And by the way, at the end of this video, check the first link in the description if you want the full breakdown of my trading model and the possibility to work one-on-one with me. Now, let's get into it. So what is the IMD for our convergence strategy? It got me funded over 20 times and has a very, very high win rate. In this My FX book, we can see that I got a 72% win rate. So how does it work? So first of all, we need context. Never underestimate context. We always need to understand why something is supposed to work. So convergence strategies originated in the late 1990s with hedge funds like LTCM, long-term capital management. As you can see here from Wikipedia, it is a defunct American hedge fund because it was dismantled in the early 2000s. Now, they are born from statistical arbitrage principles where traders exploit temporary divergences in correlated assets such as pairs of stocks, bonds, or currency crosses. The general idea here was to bet on correlated assets' historical relationship, reverting to mean when they actually got a divergence through long and short positions that actually neutralize market directionalities. So originally these strategies worked by going long and short on correlated assets. In that way they could make money without actually betting on the direction. Okay, they didn't care if the pair went long or short, they were making money regardless. It is very similar to what they do now with match betting. Okay. So in these two examples we have correlated assets. So the blue asset and the orange asset are correlated, so they move in tandem. Their movements are very, very similar. This strategy takes place when we see a divergence, so when correlated pairs actually start to be uncorrelated. So in that case, a fund like LTCM would go short on the blue asset and long on the orange asset, and they would close the trade when the pair actually got correlated again. This was the general idea. This is why it's a non-directional market approach. This is the same thing that they would do here up until the correlation was already in place, and the same thing they would do here, correlation not in place, close here when the correlation actually gets back in line. So those strategies in the 1990s were the original exploiting plays. What does exploiting mean in finance? It means deliberately and systematically taking advantage of small, temporary inefficiencies in the market's pricing or relationships between instruments, extracting profits before those inefficiencies disappear. So in that case, as you can see, they were not making money because they knew the market better than someone else, but they were making money because they were able to recognize an underlying problem that they took advantage of. So those were early statistical arbitrage on correlated bond spreads, similar to today's pure arbitrage. Like for example, latency arbitrage. It is one of the most common high-frequency trading strategies where we can make money by understanding that we have a broker with a delayed price feed. Okay, we get our information from a faster feed and we just bet on the differences. Okay, this is not making money because you know how to trade. This is exploiting the market. In fact, this was then refined by giants like Renaissance Technologies by Jim Simons, this guy here, using massive data and models for micro hedges. Markets now are hyper-efficient from HFT and AI, meaning divergences vanish in seconds, demanding sub-millisecond execution, near-zero slippage and huge drawdown tolerances. Like for example, LTCM had a drawdown of 90%. And this, of course, is something that is absent in prop firms' 5% or 10% max drawdown cap, so we need to find something else. So the idea here is that with institutional convergence now crushed by HFT efficiency, we can still profit from the root idea by using an hybrid logic. Now, the first thing that we need to do is to check daily correlations between pairs, and we use Mataf for this, a free tool I will show you in a minute. Second part is going on the 4-hour time frame, and to execute our convergence, we use volatility adjusted take profit and stop losses, and optionally we can use the COT to have a directional bias. To do this, go look back at my COT videos to understand what I mean. I also give you for free my COT terminal sheet. Now, I wasn't using the COT as a confirmation for every trade back then. I implemented it exposed on my journal, and I saw that I would have had a 40% less trade, so I would have traded less with an average increase of the win rate of about 8%. So it's not something crazy that we necessarily have to implement. But if you see that you have problems in understanding directionality, you can potentially implement it. Now, very quickly, before moving to Mataf, just know that I have a full one-on-one 12 weeks mentorship program. No coaches, no courses, just one-on-one with me, where I'll teach you my full trading model based on institutional approaches. I have my own private trading terminal. All my concepts are proprietary. We have custom indicators. We also have a community that lasts for a lifetime. And at the end of the program, you'll have the possibility to trade with me in the hedge fund, managing real capital, not prop firms, real millions. So if you actually want to become a professional trader, check the first link in the description. And now let's go to Mataf. Now, to do the first step, so see the correlations, we need to go on mataf.net. We go on Forex, Trading Tools, Forex Correlations. So once we are here, by going down, we can see all the correlation matrix, okay? Be sure to select daily. We don't want to look at the correlation on the 4 hours, hourly time frame. No, we want to look just at the daily correlations, and we need to find pairs that have a higher correlation than 80%. Now, two things that you need to remember. Don't use JPY pairs for this strategy because they are notoriously volatile and we want to avoid it. We want to have very directional pairs, so avoid JPY, and always look at positive correlations. You can see that on the right side, for example, we have also negative correlation. This means that, for example, USD CAD trades basically opposite as Euro USD. Okay, we want to avoid this. We want only to have positive correlation. So look at basically the green boxes. Okay. Now, the best pairs are usually AUD USD, GBP USD, NSD USD, so always try to look at that. Now, let's have a quick example. We can say that AUD USD with NSD USD has a correlation factor of 86. This is extremely good, so we can use this as a pair. Now, what I'd recommend you to do is to find 1, 2, maximum 3 couples. For couples, I mean AUD USD, for example, pair with NSD USD. We can also see, for example, Euro USD pair with GBP USD. Okay, we use maximum 3 couples. For my experience, using 2 couples is good enough. Once we find those, we can go on Tradingview. So let's use now the example of AUD USD and NSD USD. The first thing you need to do, you go on the 4-hour time frame and you need to switch your chart from candles to line chart. This is the first thing that is very different from any other strategy. We use the line chart, okay? Once we set up our first pair, we go here on the top right and we set up a double chart layout, okay? One on the top and one on the bottom. The second pair, we just click on the second chart and we write, in that case, NSD USD. That was our couple. And like this, we have the 2 pairs, one on top of the other, both on a line chart. So the first step for us was finding couples on Mataf, so 2 pairs with a positive correlation value higher than 80. Our second step was to set up a double chart layout, so with top and bottom with a 4-line chart. Remember, we use the line chart, we don't use candles or bars or stuff like this, we only use the line chart in that case. The third step is to look for a structural divergence on the couple. What is a structural divergence? You should know what a structure is. So we have here a high, a low, then we have a higher high, and then we have a higher low, and so on. This is again another higher high. Now, when 2 pairs have a high correlation, in that case higher than 80, we should see that the market structure between the 2 of them should be very similar. So in that case, we see that we have higher high, higher low, higher high, higher high, higher low, and higher high. So it's similar. But when something different happens, so when we see, for example, that on pair number 1 we have a higher high here, but in that case here we have a lower high, so when we have a divergence, we can start trade. So we need to look for structural divergences. Let's find an example. Now, with this, you will actually understand why we use a line chart, okay? We can see that on AUD USD, here we have a high, and here we have a higher high. So this second high is higher than that one, okay? Now, since NSD USD is heavily correlated with AUD USD, we can see that structures are fairly similar. But in that case, AUD USD, yes, made high and higher high, but NSD USD made a high and then a lower high, so we have a divergence. So if a pair makes an higher high and the correlated pair makes an higher low, we go short on the pair making an higher low. So in that case, since NSD USD made a lower high, we have now a short bias on NSD USD. The confirmation in this case for us is to wait for the next 4-hour candle line, in that case, to close bearish. We want to go short on NSD USD, so we need to confirm our directionality. Now we can see that both on NSD USD and AUD USD, the next close after we spot the divergence is actually bearish, so we have our trade confirmation. So in that case, as soon as the candle line closes, we can open our short trade. Our entry price will be this, and our stop loss and take profit in that case will be decided by the ATR. The ATR, average true range, just tells you the average volatility in a certain time period. Now, to make things easier, we can use ATR bands, this indicator. You can just find it for free by going in the indicator tab here on the top and typing ATR band. The settings are very straightforward, so just put the ATR period to 14, the scale factor to 2, and the take profit factor to 1. Okay, just copy whatever you see here, do a screenshot and do the same thing. Once we add this, we can actually see our trade is a short here. Our stop loss will be at this green line on the top, and our take profit will be on the opposite line with a risk reward of 1 to 1. And as you can see, this is our first take profit, 31 pips. This is as simple as it gets. So the first step for us was to wait for a confirmation. So the next 4-hour line needs to close in the same direction of our bias. So if we want to go short, we need to wait for the next candle after the divergence to actually close short, and vice versa for a long trade. Now for the next example, we can see here that AUDUSD made a low and then a higher low, while NSDUSD made a low and then a lower low. Okay, so in that case, if a pair makes a lower low and the other correlated one makes a higher low, we go long on the one that made a higher low. So it is basically the opposite thing that we did on the short trade. So in that case, since we have the structural divergence on AUDUSD, we should go long on AUDUSD, but we need to wait for our confirmation. In that case, the confirmation needs to be that the next close is bullish because we want to go long on AUDUSD. And as you can see, in that case, the next 4-hour line closes bearish. So for us, this is a no confirmation. In that case, we don't enter the trade and we wait for the next opportunity. Another example, we can see here NSDUSD making a lower low and AUDUSD making a higher low. So in that case, we need to go long on AUDUSD. We wait for our confirmation, and in that case, we have the confirmation both on AUDUSD and NSDUSD. Now remember, to confirm a trade, we need to see our confirmation taking place on both pairs, okay? So in that case, on AUDUSD, the next close is bullish, so we have the trade confirmed. But if NSDUSD made a bearish close, the trade wouldn't be confirmed. We need to see both the pairs agreeing, okay? In that case, both the pairs agree because we see the next close is bullish on NSDUSD and is bullish also on AUDUSD, so we can actually enter a long trade on AUDUSD. Again, this is our entry point. As soon as we have the close of the line, we just plug our ATR bands here again, we double check if everything is in line, and we simply go like this. Our stop loss in that case will be here, touching the line, and the take profit will be at a 1-on-1 risk reward ratio, so here. Now, as you can see, it doesn't look like we actually hit our take profit, but this is because the line chart only takes into account the closes, not the high and the lows. If we switch on the candle chart, we can see that we actually hit our take profit perfectly, okay? Now, for another example, we can see how NSDUSD made a high and then a higher high, while AUDUSD made a high and then a lower high. Okay, so in that case, we have a short bias on AUDUSD. We need to wait for the next line, next candle to close bearish. It happens both on AUDUSD and NSDUSD, so we have again our confirmation. So in that case, we put a short trade here at the close of this line. Our stop loss is always this line, so the ATR, and the profit is at 1-on-1 risk to reward ratio. So in the case also here we have a take profit. It doesn't look like again that we hit it, but with the candle we see that the actual low of the candle hit perfectly our take profit. So the fifth step will be to put our stop loss at 2 times the 14-period ATR on a 4-hour time frame. The ATR bands show us exactly where to put the stop loss if you set them up properly, and we put the take profit at a 1-to-1 risk to reward ratio. So as you can see, the approach is actually fairly simple. You just need to get used to use the line chart for this particular strategy, and you need to work on your ability to find divergence in the structure in your backtest. Just remember that we have 2 setups. The first one, if a pair makes a higher high and the other one makes a lower high, we sell the one that made the lower high. And on the inverse, if a pair makes a lower low and the other one makes a higher low, we buy the one that made the higher low. It's fairly simple. It looks complex with words, but as you'll see, you just need 10 minutes to master it in a backtest. So quick recap. First step, we go on Mataf and we look at daily correlations. Okay, we need to find couples. What is a couple? A couple are 2 pairs with a correlation coefficient higher than 80. All right, we look only at positive correlation coefficient. Okay, we don't look at the negative, so simply avoid the red boxes on Mataf. We need to look at correlations that are higher than 80 and positive. We avoid JPY pairs and we select 1, 2, maximum 3 couples. Again, remember to check the correlation on the daily time frame. Don't make this mistake. Once we've done that, our second step is to go on Tradingview and open a double chart layout on the 4-hour time frame with a line chart. The third step is to look for structural divergences on couples. This happens when a pair makes a higher high and the other one makes a lower high, or a pair makes a lower low and the other one makes an higher low. Alright? Once we've done this, our fourth step is to wait for our confirmation. What is our confirmation? We need to see the next 4-hour candle or line, so the next 4-hour close, to actually close in the same direction of our bias. So if we are looking at a buy trade, we need to wait for the next 4-hour session to close bullish. And if we are looking at a short trade, we need to wait for the next 4-hour session to close bearish. Once we've done this, we set up our stop loss with the ATR bands indicator set up as in the video, remember the screenshot, okay? And then we set our take profit at a 1-on-1 risk to reward ratio. That's it. The strategy is actually super simple. You could be confused at the beginning because as you can see, this is different. It's not like, yeah, wait for the liquidity sweep, inverse fair value gap and you enter. This is something different. It's actually simple in implementation. You just need to waste 10-15 minutes in a backtest to actually understand this. In that case, we are using a strategy that originates from convergence strategies used by banks and hedge funds. So we actually are using something that is a bit more professional than, smart money concepts and ICT. Thanks to this strategy, I was able to make my first payout. So I hope you can do the same thing as well. Remember to check the first link in the description for my full strategy breakdown. And if you want to be an actual professional trader with my mentorship program, because this is just 1% of everything I do. And I thank you for watching. If you have any question, put it down in the comments. I'll do my best to come back to each one of you. And always remember to use your head and to treat trading as an actual profession, not a game. Peace.